What is going on, investors? Hopefully you guys are having a great day out there. Time to talk about Realty Income Corporation, ticker symbol O. The REIT just reported their Q1 earnings. We'll jump over to those in a minute. Year to date, this thing is up 11% over the last year. 25%. This thing is rocketing to the upside. We'll talk about what kind of the price action. Have you missed the move? Are you be able to get a pullback in this one? We'll talk about that when we get over to the stock chart. Now, the Q1 came in nice. So their adjusted FFO, which is funds from operations. We'll talk about, if you're not familiar with REITs, maybe this is the first time kind of analyzing one from a higher level. We'll talk about why you analyze these companies from an FFO perspective, especially when it comes to earnings per share and kind of the dividend versus traditional valuation metrics like a net income or earnings per share or an EPS. In this case, we've got adjusted numbers, which we won't be looking at, but we can take a look at them from the high level. Is they came in at 86 cents and the analyst estimates was for 74 cents. And that compares to 84 cents in Q4. So all things being considered, everything moving in the right direction. And that probably is why the stock price has been moving higher as well. Now, Q1 revenues came in at $442 million. 416 was our consensus for the quarter. All things being considered, everything looking really good for this REIT. Now, people ask all the time, like, what REIT should I get into? And maybe they really dig into it. I personally tend to stick with the very well-known ones, the ones that are very, very popular. Now, could you find REITs that pay a higher dividend? Could you find ones that have a lower price to FFO or like a price to earnings basis? Sure, you certainly could. But one of the probably the main advantage of investing in a REIT like this that is so popular, so well traded, so well covered, is they can raise lots and lots of money. In the last quarter, they raised $670 million from common stock offerings. So we'll talk about how in some cases that's a negative for stocks, like diluting you and selling the shares and diluting you as a shareholder is bad. In this case, I actually think it's really good because it allows them to acquire more properties and create more opportunities to collect rent. Now, speaking of rent, percentage of contractual rent collected as of March 31st, you see across their whole portfolio staying rather steady. And the reason obviously why we're paying attention to this is there's still some places closed. There's still some industries that are still under duress, which we'll see here in a minute with the theaters. Now, top 20 clients of this REIT I thought was interesting. They actually pay at a lower rate across the whole portfolio. So I thought that was interesting. Their investment grade clients are paying their rent and they're paying it on time. Now, the theater clients, that business is still struggling. You see barely a 13 to 15% rent collected from them over the last few months. And then finally, the health and fitness sector. I thought this was very encouraging that that sector is paying their rents at an above average rate as well. Now, moving on to 2021 guidance, everything looking really strong here. I'm just going to come down to FFO per share. These are the funds from operations. This is how we judge the dividend and the safety of it from a dividend perspective. We're coming in at $3.26 to $3.34 per share, and we pay on this one $2.82. That's a 4% yield. All things being considered, everything looking good from the guidance. The other thing I want to show you is acquisition volume. They're looking at over $3 billion worth of acquisitions on this one. That is why I like when I invest in REITs, I tend to focus on the well-covered ones, the well-capitalized ones, because they are going to be able to survive through the bad times and grow during the good times. Now, moving on, we're going to look at funds from operations here. Well, I'll tell you what, I'll come up here. Here's our statement of income. For you guys that watch the channel, you know this is a fairly familiar statement. So you've got your revenue here, and then you got expenses. So for the last 3 months here on the left-hand column, this is our most current quarter. The right-hand column is the previous quarter. We went from 414 up to 442. So solid revenue growth over the last year or so. Again, a lot of that or some of that is funded by acquisitions and things of that nature, but this is how a company like this grows. Now we've got our total expenses here coming in just just a little bit. Okay, we're at we'll call that 294, and we're coming in at 309. Now we come down to our traditional way to analyze companies is you come down to a net income or an operating income. In this case, we're looking at net income. We went from 147 down to 96. So you might be scratching your head a little bit saying, well, if total revenue went up and our expenses went up marginally, why did our net income go down quite a bit? And so we come up here to gain on sale of real estate. We see we sold about 8.4 million, but last year we sold over $38 million worth of gain on the sale of real estate. So while this does hit this net income and it is beneficial to the company, it doesn't give us a clear idea when you come down here and look at earnings per share. How I like to look at it is funds from operation, and this is how almost everybody analyzes these companies. So you come down here, we pull down this $96 million worth of net income. You see last year it was at 147. Well, guess what? We get to add back in depreciation. Okay, that is a non-cash charge that these companies are required to put on the books, especially being in the real estate business. They have to depreciate their assets over a period of time. They have to recognize that in a certain way on the balance sheet, and this is how they do it. But when we're talking about funds coming in or coming out of this business, a non-cash charge is not going anywhere. So you get to add that back in. Now we also get to subtract the gain on real estate. So while that is beneficial to the company, it doesn't give us a clear idea of like the operations, okay? Just the straight, here's the buildings that are available, here's the buildings that have tenants, here's the people that paid rent. So this gives you a really clear idea of the, lack of a better term, the cash flow that this company is getting off of renting out their units. So we take this back, we take this $8.4 million back, and we get to see that the FFO available to common shareholders, it did go down. Okay, we went from 277 down to 267. But some of that could be, look, they sold $38 million worth of properties last year. That rent theoretically coming off the books, those types of things. So, but all things being considered, you come down here to basic and diluted FFO per common share coming in at 72 cents. That puts us right about where we want to be for our dividend rate, staying at 282. So, all things being considered, financially, the company is looking very strong. Now, coming over to the stock chart, speaking of strong, this thing has been on a move just a few weeks ago. So I'm on a weekly view right now. And so a few weeks ago, this thing was hanging out in the $57, $58 range, and it's bolted on $10. It's sitting up here about $69 per share. We've essentially filled in. So here's right before the health situation started back in February, early March of last year. And this thing took a nosedive like almost every stock, and it has not fully recovered. We have not gotten back to the highs that we saw right before that at about $84 per share, but we have filled in this big gap. While it's not a perfect gap, there was not a lot of price action in between here from about $57, where kind of the sideways consolidation here, up to, we'll call it about $70, $71. And that is what this stock has done. It has filled this gap. In my opinion, it's taken a logical spot to take a breather, because we see here right at about $68 per share, which is about where the stock is trading at right now. This is where you see some support for shares back in there. And it should act as some support, and in some cases, maybe a little bit of resistance for these shares going forward. Now, if we can continue this upward momentum in this thing, I think $72, $74 is certainly in play. That's another $3, $4, $5 on top of this one. Now, if for some reason we start seeing a pullback in this thing, you should see some support down here at $64 per share. That actually should act as some significant level of support. Me personally, I'd wait to see what happens with this one. You see here when we moved this chart back, this thing has a tendency to go on these big rallies and then kind of give it back. Okay, this is going back to 2016. I mean, this is like a 4 or 5 year view. You can see numerous times this REIT has gone on a pretty monster rally only to give it back. Monster rally, gave it back. Monster rally, gave it back. Monster rally, gave it back. Monster rally, I'd wait personally for this one to give it back. Now, I'm still reinvesting my dividends. This is a stock that I do own. I'm still reinvesting my dividends, things like that. If you want to get fancy, I guess you could sell out of this one and go find one that's, hasn't had quite this type of move. Me personally, I like to just stay in the stocks. I don't like to churn, capital gains tax and things like that. I'll just stay in this one. But if and when we get another pullback in this one, that is when I'll add. The other thing that I like to do is I like to get this one at a much higher dividend yield. Okay, I know 4% is pretty darn good for where the market and where rates are now, but if you time this one correctly, you can regularly get it in that 5% range. Again, you're waiting for those deeper pullbacks in a REIT like this. Hopefully you guys enjoyed this one. This is an interesting REIT. It is one of my favorite ones to invest in. It's got a $25 billion market cap. And like I said, if you wait and are patient for the pullbacks, this one should be on your list, especially if you're going to reinvest those dividends. And they do pay those dividends monthly, so you're able to compound those at a very regular rate. Hopefully you guys enjoyed this video. We'll be back again all week with more. Good luck with your investments.